York Fire Department Pension Fund Investment Meeting. Today is 7/18/2012. It's about 5 minutes after 10. We're at New York City Controller's Office, room 1117, New York, New York. Could we have a roll call of trustees, please?
Roll call of trustees, Ms. Ranji Nagaswamy.
Present.
Mr. Zach McKee.
Here.
Ms. Janice Emery. Here. Mr. Steve Cassidy.
Mr. Slevin has Mr. Cassidy's proxy.
And Mr. Slevin.
Here.
Mr. Robert Straub.
Here.
Mr. John Kelly.
Present.
Mr. James McGowan.
Mr. Edward Bowles has James McGowan's proxy.
Mr. John Dunn.
Here.
Mr. James Lamonda.
Present.
Mr. Sean O'Connor.
Here.
Commissioner Douglas White.
Here.
I have 24 votes in the quorum. We can start the meeting.
Thank you, Mr. Chairman. So the first item on the public agenda today is the May monthly performance review. I believe you all have the color books. And I'll turn it over to Martin to walk us through that.
Thank you, Jack. Not sure why I walked out this way. The battery's out. I have to read that. It's not many. So if you turn to page 5 of the book, short story here. Larry talked about this last month to expect. These numbers may also end up on a different note our expectations for June. But May was a dreadful month for the capital markets, and you'll see in a few pages. There are problems in Europe that continue. The U.S. is slowing down. Emerging markets, including China, is slowing down, and that reflected itself in risk-off trades throughout the capital markets. And as a result, returns were negative, except for safe haven asset classes. On page 5, a striking example of this is the manufacturing index. This is what we refer to as a diffusion index. So a level above 50 refers to expanding manufacturing. A level below 50 reflects a contracting manufacturing index. And the last reading, which just came in, of 49.7, is the first reading now in contraction since the recession, since we were in the recession back in 2009. So this is one indication of the markets and the economy as a whole slowing down. And GDP going from 2.5 down to some lower number, still growth, but to a lower number. Turn to page 7. Page 6 shows the weekly claims. Fortunately, those are leveling off. They're still at a relatively high level in a recovery. The unemployment rate is stubbornly high at 8.2%. And as you know, and as you've read, and as you've heard from us, while the rate is 8.2, the official rate, you can go on the Department of Labor's website and see the true unemployment rate, which is in the mid-teens when you include discouraged workers, part-time workers, and workers who have been out of the workforce for a long time that don't get counted in this rate. So it is a serious problem, especially given the need for demand in the economy. If you have folks unemployed, that's going to be a problem. Turn to page 14, another example of this. I don't want to keep going with examples that end up with the same result, but retail sales on page 14, this is an index of retail sales that has lots of inputs. And recently we had some bad numbers, and you can clearly see the trend is down, but last week there was a poor retail sales number that actually surprised some people. Her Daffy's is liquidating, closing. That's a low-end retailer. So this is also a sign of what's going on in the real economy. Inflation on page 17 goes both ways. CPI, as measured here, which is a CPIU version of CPI, is in decline, and the latest reading is 1.7%. Sounds good. You don't want high inflation, but actually the Fed's policies are, in fact, designed to gain traction in deflating the economy. And the fact that inflation is now going down is another sign of lack of demand. Oil prices have gone down. Some of the input prices have gone down. But also demand, as I mentioned, from not just our economy, Europe's in recession, and while China is still growing at what we would consider a robust pace, they've cut interest rates lately because their growth rate is slowing as well. Although we'd be thrilled in this country to have that growth rate.
So, Martin, the drought in the Midwest is creating a lot of tension with food prices, right?
Yes.
So that could be a...
That probably will show up in future reports. This is not what they refer to as the CPI excluding food and energy. This is the full CPI. But unfortunately, not unfortunately, people are saving money on oil, but it's a sign of a larger lack of demand and concern about economic growth. But yes, there are areas of input prices that are increasing, and foods that will be grown in the Midwest are an example of that. So separate from the demand, food prices will be going up in certain areas, or input prices will be going up. The question is, does that get passed on to the consumer who has their own problems and are probably willing to find some substitute for certain alternatives? As far as the markets go, on page 19, we have the trade-weighted dollar index. We've shown this before, and you see the trend is higher. This strength is primarily due to what we'll show on the next page, on page 20, which is the U.S. and Euro exchange rate. The Euro is now approaching a low, very multi-year low. We're in the low 120s. The level has crept down from 130. 130 was support. It broke that a month or so ago and has kept going down. Obviously, we have lots of uncertainty in Europe. Europe is in recession. There's lots of tension between the countries such as Germany and France, and the southern European economies such as Spain, Italy, Greece, of course, we know about. And ultimately, this has led to a stronger dollar versus the euro. People, in fact, are still concerned. While it's unlikely to happen, they're still concerned that will the euro survive at some point in the future? And that's reflected in these numbers. So, no, that's not good. Page 24 shows the Treasury yield curve. The Fed extended their so-called Operation Twist to the end of the year. So we read and heard about the so-called fiscal cliff, where the Bush tax cuts end at the end of this year, and some other programs end at the end of this year. The debt ceiling has to be dealt with at the end of this year. And the Fed announced their continuation of Operation Twist, which basically says that instead of just buying short-term treasuries, they're going to be buying across the yield curve to move all interest rate down to be more stimulative in that way. And it has spurred lots of refinancings where people can refinance. It has lowered borrowing costs for corporations. It has lowered borrowing costs. The problem is, are banks not willing to lend, and are people looking to borrow? And by the way, the reason I mentioned the fiscal cliff is because the Fed, in their infinite wisdom, decided to extend this to the exact same time that everything else has the same problem, meaning the end of the year after the election. So hopefully things will be worked out in Washington in a lame duck session, which it appears that's going to happen, unless they do some sort of extension and let Obama, if he's reelected, or Romney as president-elect, work things out later. But this, the yields lower is not a sign of strength, it's a sign of weakness and the Fed acting to lower rates by effectively buying up a significant portion of the issuance of treasuries. And you see that on the next page on the 10-year treasury rate. We were just talking a couple months ago about being on either side of 2% because of Operation Twist. We're now on either side of 1.5. So on a nearly weekly basis, we keep setting commodity records for low rates for long Treasury rates. While this does benefit people who are able to borrow, it also hurts savers and has distorted potentially effects in the market. But this is what the Treasury is trying to do, and they have succeeded so far. In addition to that, because of what we're going to get to in a moment, May being a dreadful month, with the risk-off trade, where does money flow? Does it flow onto mattresses? It flows somewhere, and this is one of the areas that it flows to. And so you have Operation Twist, and then you have risk-off trades where folks invest in investments that are perceived to be less risky, even though the return and potential asymmetry of returns if rates go up, investors have flocked to this area. The next page is a very interesting page. High yield as an investment grade spreads. Well, spreads have widened because of the demand, because of what we just talked about in the fixed income land and what the Fed's doing in their policies. Investors are desperately searching for yield. Now I'm talking about institutional investors, retail investors. There have been a number of high-profile, high-yield mutual funds that have closed to new investment because they've reached capacity and simply can't invest their best ideas anymore, and so they've closed. They'll reopen at some point. You'll see later on the returns. So investors, while spreads have widened because high yield is a risky asset, in general, most of the companies, while they're rated below investment grade, have lower levels of leverage than in past cycles, and are benefiting from investors' appetite and need for yield. So we'll see that a little bit later. Next page is earnings per share and P/E ratio. Larry's been talking in previous meetings. P/E ratio is very reasonable on a historical basis. The earnings per share is over $100 for the S&P 500. That comes out to about a 13 P/E, forward-looking. And the problem here is that we fully expect with the U.S. economy going from, say, a 2.5% GDP down to something below that the earnings per share estimates as companies pre-announce and do their conference calls and announce second quarter earnings, we would fully expect that level of earnings per share will go down. How much remains to be seen, what industries remain to be seen. Companies are hoarding cash, not investing as much as they have in the past, partially because of demand, partially because of uncertainty. But that P/E ratio is obviously a function of the earnings that the companies earn, and that those earnings will slowly start coming down. We have a page on page 31 that shows fiscal year returns for a few key benchmarks, the U.S. and the non-U.S., but we have that on another page, so I'll go into that in a moment. I'm going to tell you where you are. So let me skip to page... talking about the book, page 43, and for the month of May, the return was negative 4.4%. It was not a good month. And all of the risky assets were contributors to this. U.S. equity, non-U.S. equity, emerging markets, and we'll get a little bit more on that in a moment. Contributors were, in a positive sense, were effectively the core plus 5 and tips. And when that happens, that's risk off. While we're happy to have positive returns as a fixed income investment, happy to see that, but it means the overall portfolio did not do as well as we would have expected. Flipping back then to page 33, the market value is, as of the end of May, was $7.888 billion, $7.8 billion, nearly 7.9. So we're below $8 billion because that 4+% hit in May. As far as the asset allocation, on page 37 we have the adjusted weights. So it shows that on the extreme left we're overweight in green U.S. equity, we're overweight in the middle of the page in blue 2% REITs, and we're underweight core plus 5 and tips. We show in pink opportunistic fixed income simply as a information item because obviously the parking places that money is invested elsewhere and cash has been brought down to 1.9%. I can tell you that since these numbers May 31st occurred, and we'll show you in another page, REITs, for certain technical reasons and also some fundamental reasons, have been going gangbusters. REITs have been an area of the market that has been just on fire. And so we took some profits, so that overweight, which was right at the edge of the rebalancing range, we took down in June by about 1%. We have made some more investments in opportunistic fixed income, so you'll see that area increase over time. And we also put some money into the 4+5, so we're in rebalancing range. As far as TIPS goes, we're in conversation all the time with our active managers about the right time to get into TIPS. And it's not a timing issue per se, even though I just said what's the right time. The issue is with TIPS, we have negative real yields out well over 10 years, and the rally, let's just say the downside is asymmetrical versus the upside in TIPS. So we want to be careful about doing money work, but being cognizant that this is the asset allocation and this is the target that we're looking at. The next page shows where policies are, the adjusted policies, and the rebalancing ranges. Page 41 really tells the story. I'm on the page with the returns now for May. On the left side of the chart, the 1-month number, you see how dreadful the numbers were. It was pretty much minus 6% across the board for U.S. equity. And the next section shows non-U.S. equity, and that was double-digit negative returns, partially because prices went down because the Euro region is in recession, and partially due to currencies. And obviously, fixed income was the beneficiary, specifically investment-grade, high-grade fixed income. Treasuries were nearly 4%. The overall 4+5 was up over 1%. High yield was down 1%. We always expect when there's a negative equity market, high yield has definite correlations. High yield will be down. But high yield didn't go down further because of what I mentioned before, which was a fairly strong flow from institutions and retail funds. And TIPS continued to do well. But I do want to point out on the next page, I don't want to be all doom and gloom. And 42 shows what happens in June, and we can give you some estimates as well. So June, the first section on the left, you see the third number from the bottom in that section is the Russell 3000, which is our overall U.S. index, was up 3.92%, and the fiscal year, 2 columns over, was up 3.84%. The very last day in June, last trading day in June, that Friday, the market had a very big day and was a big part of that because the beginning of part of June was a continuation in May. Fixed income, core +5 was flat at 8 basis points, but for the year returned over 900 basis points, 9%. High yield had a positive month and returned 8.5% for the year. TIPS was very high, but actually the high, I'm looking at now, either the 1 year or the fiscal year returns. The highest return that we have is REITs. REITs returned nearly 13%, even though U.S. equities overall returned 3%. REITs are mostly small cap and mid cap, but small cap and mid cap actually underperformed large cap. So it really was a REIT story. There's a limited number of companies in the index, and there's strong demand for it. And so, like I said, we sold, we took some profits, we were at the high end of the range during the month of June. So, getting to what we expect for June, we expect, because of that very last day in June, we expect that the fiscal year returns will be positive. It should be in the over 1% area range. It's not 8%, but when you average out, last year is over 20-something percent, 23%. And this year, obviously, we have a actuarial rate of 8%. We did not hit that this year, but when you average it out, we're definitely over that. And the good news also, as far as market value, we estimate, and I worked out the numbers this morning. These are not official numbers, but I do want to give you an estimate. We're back over $8 billion. And if my estimate holds, we'll report to you the very next meeting, investment meeting with the official June numbers with quarterly report, manager by manager, sectors. And by the way, we're also going to have an attribution page in that quarterly report as well that details by asset class what the effect of the attribution was, not just the management effect. We expect that this will be an all-time high for a closing fiscal year as far as market value goes. So the last day of June did actually turn the fiscal year around. Any comments from SEMA on equity?
No.
Before Seamus speaks, just note that Robert Goldrich is presently in the meeting, came in a few minutes ago.
So we're showing on fiscal year to date here minus 1.5% because of the positive June. It turned into a positive number for the year. July also smothering along, looks slightly positive, but we're just into the fiscal year, so it's not a very meaningful number. I don't have anything in the public session to report on fixed income. Do we have anything on real estate or private equity? So unless there are any questions, that's my piece.
Okay. Executive session now? Basket calls or something?
We have any public session.
Oh, we don't, sorry. Okay.
So with that, Ralph, I believe you all know Catherine Bernard, who is Larry Schloss's right-hand person. So I'll ask Catherine to come to the table and introduce CEM. We've done some benchmarking analysis for the funds as it relates to our fees and other metrics that support the financial sector.
Thanks, Mark.
Did the report?
Yes, thank you. So CEM specializes in benchmarking costs and performance of investments and administration, and makes apples-to-apples comparisons and provides insights into best practices. To do this, CEM focuses on obtaining standardized performance metrics from peers and explains the results relative to a custom peer group and its universe of funds. They currently serve over 350 blue-chip corporate and government clients worldwide, and the data we're going to see is based on year-end numbers at 12/31/10. Alan Torrance, who's going to speak to us today, is a partner of CEM and has been with them for 7 years. In your book, you have a black and white version. We have some color copies, which is helpful to read the charts, if anyone would like them. I'll give you the stand.
No, you should probably sit over here.
I think you should. Yeah, I think you should.
Thank God it's a short meeting today.
Take it away. You know what? I have a color version of this, so let me distribute. We did. Oh, we did, yeah. I'm sorry.
There's another copy. We have one more copy. One more copy down there.
Terry. Alan, A-L-A-N. Torrance, T-O-R-R-A-N-C.
Okay, we're ready. After this, there's some, is everybody ready? Okay.
Thanks very much. My name is Alan Torrance. I work for CEM Benchmarking. I'm a partner with the firm, have been for 6 or 7 years. CEM is an independent private company. There are 22 of us in Toronto, Canada, and all we do is run a database of costs for pension plans on the administration side and on the investment side. As you can see from the front page, on page 1, On the investment side, we have been doing this for 20 years. It came from the idea that running a pension fund is like running a business. You should look at the cost side, and you should look at the revenue side when you run a business. When you run a pension side, you should look at the return and what are you paying, so that in the end you're looking at the net value added. In other words, what finally goes to the members after you take costs into account. For 20 years, we have been growing the assets of that database, and I'm going to talk to that today. For the 2010 calendar year, we worked with the City of New York pension funds to run a report, and this is a presentation of that report. The findings, I guess, were that what you are doing through external management, you're getting a very good deal on, or you're low cost. However, when you look at funds of your size, which we're going to in a bit of detail here this morning, funds of your size are using other avenues to do their investing other than external active management. And they're the two major findings, I'd say, from this. Turning to the second page, this just gives a quick description of the database. And I'll just point you down to the left-hand side. The breakup of corporate, public, and other. I'll talk to the peer group in a minute. You can see that we get about 120 corporates with an average of around 7.5 billion. The publics we get around 70 each year, and these make up most of our clients. The publics do it as part of their annual fiduciary duty to look at the costs of the plan. And they're, of course, a little bigger coming in at around 25 billion. We have United States, Canada, Europe, and Asia, as you can see from the bottom. And when we were putting a peer group together for this group, we were asked to look at both the United States publics and the Canadian publics, which we did looking at page 3. So after working with Larry and Catherine and the group, we came up with 18 sponsors, 6 are Canadian, 12 US, all publics, ranging from 41.1 billion to 225 billion. There is a bit of a range there because we have to try and, at this top end, it's hard to find peers. This is a very large fund. Of course, we're talking the combined assets of the fund. The median size is around 80.5 billion, which was as close as we could get to the 113 billion of this fund at the time.
Combined assets of the 5-year city funds?
Correct. Yeah, and that's what we've run this
I'm sorry,
on.
what was the question?
So asking about, you said the combined fund, but I just asked to clarify, that's the 5-year city pension funds
He said yes.
added together.
Yes. And that's what the analysis is about today. So we would be happy to do it for each individual fund if you thought that worthwhile in the future. In terms of the peer group, what we're looking at here is a cost comparison, and so we want funds of equivalent size because buying power is very much a determinant of cost, and we're looking at cost today. So we're going to work through the analysis with this peer group. There are a number of factors that obviously will make you different to your peer group. First is the policy mix of the fund, or the combined fund. What you're investing in definitely determines the cost, underlying cost of the fund. However, what you're investing in comes from important factors like the underlying membership of the fund, the rules and regulations of the fund, how much inflation you have to tag, etc., etc. So asset liability determines that. What we're looking back at the other way is trying to understand how that's going to affect the cost when we compare it to your peers. If we look at the table in front of us, we can see, and I'm just looking at the 2010 numbers for your fund, your 62% compared to the peer average of 48% for total equity. So you're much higher total equity than your peers. In terms of bonds, you're about the same. But where it falls out is in the real asset hedge funds and private equity at the bottom, where, you can see that your peer average is 12%, 2%, 9% compared to yours 3, 0, and 5. So that's where there's a real difference, and already we can state that that's going to make a difference to the cost when we're looking at cost. Because real estate hedge funds and private equity, real assets hedge funds and private equity, and by real assets I mean real estate, commodities, natural resources, etc. Those that category at the bottom has much higher costs than U.S. public equity does. So we can draw some conclusions there. Of course, it also is going to give you some return differences. And we're not going to talk much about return other than when you're investing and spending money, what are you getting for that investment? So on the next page, we look at not the total return, but the value added, which is the policy less benchmark. Sorry, so the actual return less policy. Or in each individual asset class's case, it's the asset class return less the benchmark return of that asset class. So the value added. As you can see, over the last 5 years, you've had in 2008, you were high value added, 2009, low value added. The 5-year comes in very close to zero. And if you look at the table that says value added in category, that's how you perform within each asset class. And it's jumped around a little, but your in category is slightly positive. Overall, though, your total value added is zero. So that's something important. That's important to bear in mind when we're looking at cost and what you're spending over and above what your peers might be spending for the same thing. Just to look at that very quickly on page 6, your in-category value added by major asset class, your equities, you're very similar to the U.S. average. However, for fixed income, you didn't do quite so well compared to the U.S. average. That's over the last 5 years, and the last year we're taking into account there is 2010 data. So with that as a backdrop, what we'd like to do now is take a look at your costs. And on page 7, these are the costs that have been presented to us by the Hoopla. We captured the costs in 2 boxes, if you like. The top box are the investment management costs, all those costs associated directly with investment management. And then in the bottom box, those costs associated with investment management, like custody, oversight, etc. We collect them by category, external costs, internal. By internal, I mean where funds are running the assets themselves. So they have investment staff and they're doing the investments themselves. Also by passive and by active. Just a couple of notes on collecting the costs through our annual survey that we do for the 200 US funds. We do scrub the data as much as we can. We look for reasonableness with the data. We try to question numbers that are not what we would consider reliable. And of the 200 funds that we do use, we probably get close to 300 surveys. So there are a lot that we don't use. Typically, these are the smaller funds, and people have not been paying attention when they fill it out. So the quality of the database is our business, and we look very closely at that. There are a couple of things that the industry at the moment cannot provide to itself, really. And one is consistent and accurate performance fees on non-public assets. These are often netted out. They're often in contracts that people don't see. They're not always accrued in the right year, and we do have some trouble collecting that in terms of comparison. So what we do for the attribution, cost attribution, we're going to do in a minute here, is we actually leave the performance fees for non-public assets out of that analysis. It's not perfect, unfortunately. We're working with the industry. In fact, 25 of the top funds we're working with this year to try and collect those, and hopefully that will filter down as time goes on. So your total asset management costs, including costs associated, 39.2 basis points. What we're going to do now is have a look at that and see if that's reasonable.
Yeah, so on page 7, you talk about costs, focused on internal and external. There's one, it's the hatch. So that's the cost of all the personnel costs, or is that, what's the cost? That's the focus on our desk. That's our focus. That's our cost of running that business. Sitting employees, right? Sitting employees.
So it's separate from the numbers at the bottom? So it's not double counted, right?
It shouldn't.
No, it shouldn't.
Check.
Because I thought the total band cost was $3 million, so you're saying, but this must include systems and stuff too, right?
Absolutely.
I can't hear, Ranji, I can't hear you.
I thought the total band cost was $3 million, and if this is 2.2, I'm just a little bit confused as to what these numbers are.
Internal management touches everything. So it's
Yeah,
not
I'm just actually, it's a question for us
Yeah.
more than for you, Alan.
So you're looking more at the S-course.
I just, isn't BAM like a $3 million number?
That's about right. Yeah, I don't think
So the 2.2 for internal management is 2.2 out of 3? I mean, that's just not right, right?
Well, maybe it should all be in fixed income.
You know what, I think I know the answer, I'm not positive, so rather than sort of
Yeah,
belabor
can we
the
just
work,
come back
let me
to
just
that?
come back to that.
Great.
It'll be in one bucket or the other bucket.
Right, I just want to
make sure it's in the right bucket.
counted.
Sure. I think we did go through that in terms of moving on, just taking a look at the total costs over time. The graph on page 8 can be a little scary, but it's industry-wide, and we'll see this as we go through the presentation and look at some of the research as well. 2006 to 2010, your costs have increased. However, you can see that most of that increase has come from private assets and hedge funds. And this is a fairly typical sort of example, as funds are moving more and more of their asset allocation into more expensive funds, their total costs are increasing. That does not take into account return, risk, and all the good reasons you're moving there. It's just a statement of the fact that total costs for combined funds and total costs for most funds are increasing as they try to get away from the public assets and diversify into non-public assets. What we're going to do now is try to benchmark your cost using the P group. And the first thing we're going to do is take out the effect of asset allocation. And we do that on page 9, where we're doing what we call a benchmark cost calculation. What we do is take your asset allocation weights, but use the weighted peer median cost. So in other words, we're saying we're taking all the peers and giving them your asset allocation. And then we're doing a weighted average to say that's what a benchmark cost would look like. So we're using the peer costs, and again, just to go over it again, that's why the peer group needs to be of the same size so that we can represent it properly here. Your total benchmark cost, looking at the calculation there, is 39.3 basis points. On page 10, we compare that to your actual cost to find that you're coming very closely to what we would expect a fund of your size, public fund in the United States, to be spending. However, what we want to do now is look to the next level and see if there are any offsetting messages, and in fact there are, and I've already alluded to those. So on page 11, we're going to take that number and divide it into two, or attribute it to two factors. The first of those factors is how are you doing things compared to your peers? Are you using the same avenues of investment that your peers are? Are you going direct? Well, to the conversation we just had, is it internal or external? Are you using external management? Are you using fund-to-fund direct or other means to invest in some of the non-public assets? And then we'll have a definite factor on cost. As you can see from the numbers in front of you, you do have a higher cost implementation style, which is basically external active management, to the tune of $47 million. The offset to that is paying less than your peers for that. So the second bucket is, okay, given you're doing what you're doing, what's the cost of doing that compared to your peers? And we find that because you're putting so much into external active management, you are getting some benefit from that in terms of negotiation. Let's just, I'm going to step...
I like that point, so I just want to make sure we do a good job negotiating on behalf of the 5 funds.
I'm going to quantify that for you to have in a couple of pages. The first thing we're going to look at, though, is we're just going to take a bit more detail on the implementation style. This, I think, is an interesting story for you. looking at page 12 where it's graphed, the four we're looking at here are internal passive, internal active, external passive, external active, and you can see that you are 97% external, 37% of that, 37% external passive. If you look at your peers, we're going to ignore the funds here, we're just looking at the peer group. You can see the peers are 20% internal passive, 33% internal active. And that comes to, over half their assets are managed internally.
And that's primarily the inclusion of the 6 Canadian funds, correct? That influences those percentages?
I can't comment on the individuals. Some of those Canadian funds do a lot internally.
CalPERS is internal, Texas is internal.
You have state-level actions.
That includes the U.S. publics. They're about comparable. Because we have from another source that information. So.
In fact, in 2 slides, we can break that down. Moving on to the next page. Very quickly, one of the things we look at is fund of funds. Fund of funds are a very expensive option in terms of investment vehicle. You can see that your peers only have 4% through fund of funds. You have 7%, so it's not a lot, but it's still a factor, and we'll quantify that for you in a little while. You can see the U.S. funds, the smaller funds who don't have the size or the options to invest through other means other than fund of funds, are 30% in fund of funds. So they're paying because they're small. That's where the bigger funds get the advantage. Page 14 and the implementation style question. Larry and Catherine wanted me to break this out for you, and there it is. You can see your fund again on the left, the peer group, and then all U.S. corporate, all U.S. public, other U.S. and all U.S. funds. So
you didn't break out the peers between U.S. and non?
no, we can't do that. We can't give away any particular funds.
Not an individual, but just the 6 and 12 that would...
We do. What else do? Yeah, to the point, there are a lot of public funds out there. We do some of them are fairly smaller than this one. Just a quick look at trends in implementation style for your fund, and your external passive has dropped from 43% in 2006 to 37%. Your external active has grown a little, and internal is just that cash again. Implementation style again. Now, just looking at, I won't spend much time on this page. Looking at the peer
Where's
group.
our fund of fund 0? We'll just round out to 0. Well, we had, I think ours was like 7%, right? Or it's percentage of private assets.
2010, though.
No, but, and I guess it's percentage of private assets is rounded out to 0.
Yeah. I think it's
The total?
around. It's definitely around.
On page 15.
Actually,
Because on page 13 you showed that as a percentage of private
Yeah, I
assets
think-
we were 7, but our
to be
private
perfectly honest,
assets
I think that percentage of fund of funds should probably be in that line, because we're breaking it in external, internal,
okay.
and then the fund of funds. Just very quickly, on the next page, I'd like to get to the cost attribution. Again, implementation style, looking at your peers. What we see here is external active management has increased over time. Also, the universe, on the second chart, external active management has increased over time. That kind of runs against the grain of thinking until you realize that when people are moving into alternative assets, which they are, a lot of that is done through external active management. And so that it's probably a better view would be looking at public bonds, public equities, how much of that is managed externally. The overall external active management is going up, also that move to alternative assets. With that background on implementation style, I'd now like to take you to a scary page on page 17 full of numbers. I'm just going to run you through this quickly and point out some of the important factors here. This page, just a bit of background on this page, external active management is easily the most expensive of the four options when we're looking at it that way. So what we do is we calculate, for each asset class, we calculate a cost premium, which is the difference between external active management and the other three options, being internal passive, internal active, etc. And so we're just comparing on this page the percentage of external active management used for each asset class. If we look at the top line, the combined funds have $37 billion in US broad oil stocks. However, 0% of that is through external active. You're using external passive for that. 15.1% of the peers are using external active, which is a much more expensive option than external passive. There's a 44 basis points cost premium, so the decision to use passive rather than active for that particular line item equates to about $24.5 million for the 2010 year. Now that's just one piece of the picture. Obviously, we need to come back and look at the other pieces there, but that's quite a large number. If we then look down the page for the other public assets, we can see that you're using external active management very highly compared to your peer group. And so that's costing you, and that's why you're getting some very big numbers. For EFI, for example, 89% external active compared to a peer average of 48%. That's quite expensive, so that's costing. So what we're pointing out here is there are different ways to invest in these asset classes using external active. It's an expensive way to do it. Any questions? When we look at the bottom, the non-public assets, we're not just saying, and this is where the confusion came a minute ago, we're not just saying you're using external active. Within external active, there are 2 or 3 different ways to grow. You can do it directly, you can do it through a limited partnership in some cases, or you can do it through a fund-to-fund. So we're breaking out, so diversified private equity, for example, $2.7 billion, you're 100% external active, compared to your peers of 92%, which means there's an additional cost of $2.6 million. But we then look at how much, or what proportion of that you're using through fund-to-funds, which again is very expensive. And that's where you're adding an additional cost because you're going through fund-to-fund. So you're going external active through a fund-to-fund is more expensive than going external active direct.
How are you defining external fund-to-funds in the private equity space? Is that secondary managers, or I'm not seeing how they have 40% fund-to-funds.
Your fund has 40%?
Yeah, I don't get that.
I'd have to hand that over to the data because
they don't use a lot of fund-to-funds unless you're counting secondary partnerships, and it wouldn't be that high.
Alan and I need to group on that and figure out what goes into the calculation and get back to
I
you.
need to look at the data.
You just check with Barry.
Okay. Yeah, I'm looking at that. Moving to the next page, we look at the effect of using external active management. Now what we're looking at is the other 3 options. So you can go internal passive, internal active, and external passive. There's not a lot of news, I guess, from this page. What we do see is that your external passive is cheaper than the other 2 options. So external passive that you've negotiated is cheaper than an internal active or running an active internally. So it is a small saving. Moving on to the next
I'm
bucket.
sorry, just so make sure I understand, our external passive is cheaper than our peers' internal passive?
No, we haven't looked at that yet. What we're saying is the option of external passive is cheaper than the median of internal active, internal passive.
Oh,
Okay. So it's just, you have three options where you're using it as a flush out. We do it that way because these numbers are never very big, because the three options are price, quite close, quite often. Internal active is a little more expensive.
But internal passive is not a lot less expensive.
Internal passive, we'll look at this. In fact, let's turn to the next page. So for external investment management, what we're doing now is looking at the bucket and saying, okay, you're doing external investment management, what do you pay compared to your peers? So this is just a straight like-to-like comparison. And to your point, 37 billion is external passive. You're paying 0.3 compared to an average of 0.8. In the last two pages of the presentation, you can compare that to internal passive. Looking to it very quickly. Sorry.
It is about 1.1.
Yeah, it's actually, you're getting a very good deal.
I might just want to observe on this page is something I think the trustees have known for a
You
while.
gotta talk louder, we can't hear you, it's 100%. You can do it.
I can do it. I think this is something most of the trustees have known for a long time, but in my 22 years here, the one thing the Bureau of Asset Management has always done, and done what I think successfully, is hold down how much you pay to your external managers. And page 19 summarizes that very well, showing that on average, you pay substantially less. And that's been a continuous process that's gone on ever since I've been here. And I think the trustees and the Comptroller's Office should take a great deal of pride in recognizing and getting the best dollar value possible with the external management that you've used.
Thank you.
Well done. This is a very impressive page.
It does have some good numbers in it, not that I can say it's good or bad, but I'll show you the numbers. Nearly every number down to real estate is a saving and not a small saving. There are some big savings there. And this is compared, just to make the point, this is compared to your peer group. This is funds of your size playing in the same space. This is not a $2 billion fund. Okay? This is funds of your size playing in the same space. When you get down to, I mean, the only real cost there is real estate ex-REITs active, and you're a little more expensive there. But overall, that's a big saving. The next page is just to show you the fixed income other, which is really cash, and it's more for your information if you have any questions. Moving through to page 21. This is always an interesting page. So these are the costs associated with investing. Whether you do it internally or externally, you have to have custodians, you often have consultants, and you need to spend some money on oversight. Your oversight number comes in as a big saving. The one thing CEM will say on oversight is that it's not a cost you necessarily want to minimize. A lot of other costs you do want to minimize. And everybody should have each fund should find its own level of oversight that is right and appropriate for its circumstances and spend the right amount of money on that. So that is not a cost that we would see having a saving is necessarily a good thing. It could actually be you're not spending enough. But I'm not commenting on this fund in particular.
An example might be risk management systems. That as a system, you should be prepared to spend the extra 80 basis points if plan requires a risk management system to manage our risks. As an example.
That would be an example, yes. As you can see, custody, consulting, performance measurement, the numbers are there. There's nothing really of headline news. So I'd just like to take a minute to summarize what we've just been through and perhaps give you the headlines. We just did a cost attribution, comparing you to a peer group of funds your size, and what fell out of that. The headlines are, well, the biggest number on the page is that you're using external active management more than your peer group, and that is costing you. The next is the one we just mentioned, and that's your negotiation with those external managers is saving you money. But the numbers don't quite match. And the other numbers we have discussed.
So why are internal investment management costs higher than everybody else when we only manage cash internally? That's just about stumps me, because everybody else has so much more internal.
Oh, no, but we're doing a like-for-like basis. So if you go to the internal management page, which I sort of skipped through.
So if they manage only 3% internally, what would their costs be? They'd be lower?
So we're just looking at that fixed income active part of the
Okay, exactly. So it's just on that.
What page?
Sorry, page 20?
So just on managing.
Absolutely.
The
Yeah. But it's not a great picture. We're doing it by asset class.
Got it.
What are you managing? How are you managing? What's it costing you compared to people? Any other questions? Turning to page 23. What we're doing now is bringing the two together. So we're looking at your cost effectiveness, if you like, so your excess cost, which was about similar to the peer group, even though there were two underlying and opposing streams there. The excess cost came in around the peer group cost. And then we're looking at your net value added. In the investment world and across this table, you probably hear value added quite often. From CEM, you will always hear net value added. So that is the value added after cost, which is what, in the end, goes to the limits. And from that, and plotting you against your peers and the rest of the U.S. and, in fact, the globe, you come up right in the middle. So for this 5-year net value added, you're right in the middle of the bunch. Where you want to be is top left, which is where you're adding value after costs, and you're keeping your excess costs down so your costs are reasonable for what you're doing.
So this is the part that reflects performance relative to the amount spent for it?
Correct.
So this can be boiled down to 0.3% per year lost for the last number of years for the active management invested in? Is that a proper description?
Yes.
So those investment managers are being overpaid for lack of performance.
Or it's a wash. It's a bit of a...
Active management costs money. And are you getting value from that active management? That's why a lot of large funds will, the options are go passive or go into.
No, not necessarily. They don't have passive options in many of the liquid asset categories.
Sure.
So you can't get access to that.
Sure. I think I was thinking about
market without
absolutely
paying a management. Can you go back to page 20? I just want to understand the table better. You're saying that BAM is spending roughly $2 million, 29.8 basis points to manage $750 million in cash? That doesn't seem, that $2 million, if I'm doing the math right.
Yeah, that goes back to the $2 million.
I don't see how that's possible.
I think I understand that. While cash is internally managed, and obviously would not have that 20 basis points, it's effectively zero. Part of the ETI program is internally managed, and part is externally managed. So I think the way we categorized this was internally, even though part is internally and externally. So this reflects the external piece of the ETIs, really higher managers in the ETI space. So it should really be broken down in a different way that doesn't show that.
So
It should be part of the external.
So should the $749 million be higher, or you're saying that we should break out the cost and the 29 basis points would be lower? Okay.
We'll be happy to have that resubmitted. Okay. I was also asked to just dig into our research section. We have 20 years of data with 200 American funds, and just come up with some things you find of interest. I'm going to run through this very quickly, just to give you a feel. I mentioned before that U.S. total costs were increasing across the country, and that is again because people are moving more into more expensive asset classes, hedge funds, private equity, etc. There are the actual numbers on page 24. I've already alluded to it in terms of the combined funds here, but looking at the U.S. plans, external active management has increased for the 10 years from 65% to 73% over that time, and the trend into alternatives. And as my friend pointed out, that has to be through external active management. I'm just skipping quickly here. If you have any questions, I'll be happy to take them. The change in policy mix over time, and you can see there where private equity and hedge funds in 2001 was 4.5%, in 2010 it's 11.7%. So again, it's just more numbers proving the same thing. Each year in our research, we put characteristics of best performing funds. The observations I'm about to talk to are from 1991 to 2009. It's important to remember that when we look at some of these observations. We've run regressions on each of these to see what the effect was in the database. The things that didn't really have an impact, it doesn't matter if you're a corporate or a public. The number of external managers didn't really have an impact. Probably more interesting, I think, are the characteristics that resulted in higher net value added. The bigger the fund, the better the value added. Total cost, if you can keep the total cost down, and we'll look at that in a minute. At this time, given 1991 to 2009, U.S. small cap holdings did very well. It might be different if we looked at the last 5 years. And private equity holdings did very well over that time period as well. And those who got in early in private equity, I guess, did quite well. And internal management did a little better. And I just do have the numbers to support those that I'll run through very quickly. On page 28, large funds did better than small funds. Well, for those of you in the statistics, there's the T-stat and everything on the right-hand side. But on the left-hand side, for every 10-fold increase in size, net value added increased by 15 basis points. Now, it's not linear, but we took a snapshot at the 100 million to 1 billion, and it was a 15 basis point difference there. And just to prove the point, it was primarily due to total cost, private equity, and small cap stock over that period. On the next page, funds with more internal management did better than funds with less. We ran that regression. The table indicates that a 10% increase in internal management resulted in 3.6 basis points increase in net value added. Not necessarily value added, but net value added. And then we just looked at those funds that were high cost and sort of split them into two groups. Those who were spending a lot and those who weren't, and those who weren't spending a lot did better than those who were.
Is this our universe or this is the total universe?
This is
Total funds.
This is research, so it's coming from all the funds, all the U.S. funds that were in for that period. So you don't have partial advice. I'll leave you with the last page. Obviously, I'll take questions. There are 2 pages there just for you to review and look at the data. Page 31 we've already had a quick look at, and it's showing your costs and then the peer median cost for each of the asset classes by the investment option, if you like, or the implementation style. And let's take private equity as an example, diversified private equity. Reading across the page, you're coming in external active around 166. Fund of funds is 260. And then if we look at peers, internal active at 37.5, external active 165, which is reasonable with your numbers. Fund of funds 250, And I guess the only other thing we've already pointed out, I was going to point out, was your passive management, which is you're getting the best deal on the page for U.S. stock. Any questions?
Any other questions? No, thank you.
I guess one question is the 5-year number of value added relative to net value added relative to cost. That's a point estimate. How would you suggest that has trended? You know, the Amoeba page where you had all...
For the combined company?
No, in general.
Well,
Page 23.
yeah,
Is this a particular 5-year period? Is there noise around? I mean, is there any signal value to this is my question.
Sure. The way we're running this, just to remind you what it is, net value added, so value added less cost. But the excess cost is you against your pay group.
Right.
So we do that for each fund. We'll put them against their pay group to get the excess cost. In every country, every time period, it looks like that.
Right, so the universe
It's a gunshot around the origin. If there was a definite trend to spend more and get more value added, there would be, you could run an ask and get a line of best fit there, but that's not how it's in. And part of the reason, again, we're biasing it a little because we're doing the excess cost of you against your median using your asset allocations. We do that for each individual.
All right, thank you. Thank you. Deb?
So, just to summarize very briefly, as far as the report goes,
Does BAM have any conclusions on this?
that's kind of where I was trying to, thank you.
I'm sorry, Archie, what did you say?
So this is a lot of good data, very helpful data. I wonder if BAM has any thoughts for trustees on what to make of all this and what this means for how we should be thinking about improving our own results.
And it is things that we are thinking about, and I would tell you that having a lot of this data is now almost a homework assignment, sort of where do we go from here? So I think in the fall we'll be coming back to the board with suggestions as to how we want to look at the management of the fund, where might it make sense to do some things internally, where might it make sense to stay where we are. So there'll be future board discussions to come. We are taking this data and looking at what options make sense with the framework we have and where we can achieve some efficiencies, particularly as we change our asset allocation going forward. And again, that to me is a big takeaway.
Right.
And we're moving now more to alternatives. Those are obviously more expensive. And what's the best way for the board to get the biggest bang for their buck in a way that they're comfortable with?
And I'd just like to suggest that as part of that process, the board may wish to consider reviewing benchmarks at individual asset class levels. Active management is supposed to pay for itself and add value. Or, if add no value, fine. But both the problem of statistical information and the choice of benchmarks both makes it difficult, but it makes it very important. And if the statistics are to believe from this report, active management has not earned its keep in the fund for the last 5 years. And that can be unique to the 5 years. But this has to be addressed, I believe, asset class by asset class and manager by manager. And the board may wish to think at the policy level about exactly what and how it wants to go about judging the success or failure of its active management more critically than it has in the past.
You know, Bob, your point's well taken, but I have to say I was a little concerned when you congratulated us on negotiation abilities with active management. I didn't get that part of the commercial. I was wondering if you were not feeling well. So I see you were just saving it up. So but your point is well taken.
I'm glad to satisfy you with that.
I was concerned about your health or anything. You didn't really give us the other part, so I'm glad you're doing it.
Well, unfortunately, it may have turned out that you managed to negotiate a real cheap fee on people who then lost money, but on average, I know hopefully that's not, well, actually the statistics say maybe that is true, but that is, now I'm going to go back to the point. The Bureau of Asset Management and the Comptroller's Office have done a great job over the years negotiating with managers. I'm not sure at the policy level the board has been tough enough on the issue of exactly what the benchmark should be and whether or not the managers have earned their keep. And in the course of taking advantage of all this information, it's something that the board might want to give further consideration.
Karen, as the project manager here, do you have any comments that you want to add?
Well, just that we think this is very interesting and very thought-provoking, and as Thad says, there'll be follow-up. And essentially a menu of choices for the board to look at.
Okay. All right.
So, Mr. Chairman, in looking at our public agenda, BAM is done. So, I please the board with the motion that we go into executive session.
Is there a second to the motion?
Second?
Any objections? Then the motion carries. So we're in executive session. And
Where are we?